didn't do our sardine check.
We didn't do the sardine check.
Everyone gets straight. Everyone gets okay. There we go. All right, and we're good. Oh, check there. Check 2. And welcome to the show, everybody. Happy Friday. Happy everyone. Just wanted to open up real quick. Our hearts and souls go out to everybody affected by the current media in the protests and the stand-ups. So just wanted to make a quick note to that. Just appreciate in our city, Portland, doing a lot of great stuff out there. Putting that aside, we have our job to educate home buyers, people buying, selling, industry professionals. And we're here today to talk about a pretty common question out there. And it comes across the board quite often, that being, how much money does it take to become a real estate investor? So I brought in the whole crew, Casey, Christian, rolling in, and we're going to dive right into it. Gentlemen, thanks for taking the time today.
Thank you. Glad to be here.
Yeah, thanks, Addy.
Yeah, we're cranking. So I think I'm going to let Christian kind of open up with what is a real estate investor? Because we got to all be working on some common terms here. One being to me, I use it as more than one property. Would you consider that as well, Christian? Hit me with.
Totally. I think it starts off with that one, your primary, and then as you're looking to acquire more properties and get some monthly residual on some income or build some equity within your portfolio, that would be considered a real estate investor to me.
Fantastic. Yeah, it's a good note, guys, because we get this question all the time. Hey, I'm going to buy my very first home and then I'm going to turn it into a rental. A lot of people are looking to do that. So we've helped a lot of people get into it and structure it. So I think just rolling through, first and foremost, as a first-time home buyer, which technically as a first-time home buyer, it's not having ownership within the last 3 years. So just because you've potentially owned a home in the past doesn't mean that you're disqualified from that first-time home buyer status. And if we're speaking just to a conventional loan, 3% down minimum on the conventional loan, first-time home buyer qualification. So that is a great thing people can take advantage of, right? Right, Casey?
Absolutely. I mean, even if it's that first home, right? As well, the first thing, being real estate investor, you probably got to own real estate. So let's start with the first property, right? So 3% down to get into your first property, get that first asset under your belt. Great way to get in.
Yeah, and I think that's a good point. So you get in, and when you deem it your primary residency, which is the most attractive way to first get into your house, you're going primary for a couple different reasons. One, you don't have to put 20% down or more. So that is the first attractiveness. Secondly, often, and get with your lender, the terms are going to be much more favorable as a primary residence over an investment property. And Christian, would you mind diving into why that is? Because I think a lot of people don't understand why the interest rate might be significantly higher on an investment property versus primary.
Yeah, definitely. So I think from an investor standpoint, they're looking at your primary home as you're going to make those payments first. Your investment properties, if let's say we're in a pandemic right now, maybe those mortgage payments aren't going to be made prior to your primary residence. So there's some added risk to those loans, and as you put down more down payments, those risk levels go down. So you're going to see a more favorable rate than if you were to put down the minimum down payment on that first investment property. So you got to think about it from the investor standpoint. Okay, it's a little bit more riskier. Your resident or your borrower is not in the home. So there could be some deferred maintenance and different things like that. So if you think about it as a whole, there's a little hits to it just from that factor.
Yeah, that's a good point. And just to put it in a summary, the investor, the person that's putting forward the money for the loan, believes that the person will pay their home bills over their investment bills. So that's why the interest rate's going to be a little bit higher. It's a risk assessment for many people. That's awesome. I think that's just a really good thing to put down. Most people want to grab it into their primary and live there. So the requirements, I believe, and guys, hit me if I'm wrong here, like you need to live in that home for a minimum of 12 months before you're eligible to rent it out legally, correct?
That's right. That's
Yep.
right.
Yeah. Casey nods his head. Yeah. That's it.
Yeah. Totally right.
So you see that a lot of people want to get in. You're first time home buyer. Hey, I'm going to go 3% down. I'm going to stay here for a year. Some of the biggest changes I've seen this year are because people want to know, how do I use my rental income to then buy another house? And there has been some changes to that. One of the biggest ones is, you used to be able to get through by just demonstrating a 12-month minimum rental agreement with a 1-month deposit from your renter, and 100% or 75% of that total rent was calculated back to qualifying rent or qualifying income for your next purchase. So that's how people were able to navigate through buying a second home. One of the biggest changes that I've seen this year was now they don't let you inflate your income. Meaning, say you are cash flowing $1,000 over your payment with your rental, like your mortgage is say $2,000, you're getting $3,000. Unless you can demonstrate a history through tax returns, the max you're going to get is your PITI, your principal, interest, taxes, and insurance, back as qualifying income. So essentially, you can't inflate tenant income to make sure that you qualify for the next, right, guys?
Correct. And I do believe there's an equity position too. If you do want to use 100% of the new rental agreement for the exiting property, I believe you have to have at least 30% equity in that property to use the 100%.
Yeah, there's some equity position considerations.
Yeah, so there's little tags in there within the regulations and rules. So, like you said, get with your loan officer and definitely talk about those details, because that's what's going to make or break a investment property deal.
Yeah. And kind of touching on that too, with COVID and these times, you have lenders changing, guidelines or things are, coming from above, Fannie and Freddie, that are changing. So it is very important to have these conversations and get with your loan officer or who you're working with, because there was something I came across the other day that I noticed, during these times is more of they're doing rental income restrictions on some stuff. So if you see rental income coming in over, I think it was like 30% of their gross income, there's going to be of their monthly income. The rental income is 30% of their monthly income. There was some restrictions that they might knock down that rental income on that. So there's some stuff you want to be just having those conversations with your loan officer and having that loan officer dig deep into these guidelines, because right now these things, they change, or overlays are getting put in place or coming off. So there's stuff you want to check, because COVID has changed up a lot of these different things that we thought were standard, go-to rules are now changed.
Mm-hmm. Yeah, no, that's a good point. And I think particularly to self-employed individuals are some of the more challenging individuals to determine income and qualifying standards. It's so specific to what lender is going to, shave off a little bit of conservative analyzation for income. People that have more of a W-2 position based salary, they're not dependent on commissions, are likely going to breeze through a little bit easier of figuring out what they can qualify for. So just kind of going back though, guys, they get into, this is the common thing. Everyone, I'm going to turn it into a rental. So typically we'll see, I would say personally, I see a 2 to 3 year average. They're going to be in that primary first. Like everyone's like, after 12 months, I'm just going to do it. But right. I usually see like 2 to 3 years. That gives them some more time to save up, say like 5% down payment on the next, and organize to have their first home rented out. So that is the way to do it, guys. I would say a couple different considerations, and Casey or Christian, please chime in. One of the things to note is say you own a condo or a townhome, you want to review the HOA guidelines regarding rental caps. Like, is this unit available for renting? Also, your city requirements. A lot of people think that they can just Airbnb it out or make an ADU type of situation. Christian, have you come across that before in the past where they thought they could rent it out, and then because they didn't do their homework, they didn't know that their particular building was capped out?
Yeah, definitely. Before you buy any condo or planned unit development, make sure you're going through those CCNRs. The CCNRs are what's the guidelines for that condo association, which is going to put out the rules and regulations of what you can and cannot do. Um, and we do that on for at least I know I talk about budgets and what the capabilities are for rental in the future for every condo that's purchased for my client, because that's huge. Some people want that. You know, they want that condo to be their primary. They don't want to have their neighbors be renters. That's going to work out great in some cases. Other cases where you do want it to be exactly what we're talking about today as your next investment property, make sure that we are making note of that with that purchase.
I just got I got a text too, and guys, guys and gals watching, and feel free if you've got any questions. This is as much for you guys as it is for us. This is the MLO group, the Modern Loan Officer, where we look to create a transparent environment for people to learn and engage and prepare themselves for home buying and home selling. And some of the emails and stuff I've been getting all over the place have been really fun to feel, just all over the nation. But one of the probably 4 times yesterday and then today, I've had people ask me, do you think that there's going to be a real estate crash like we've seen during the Great Depression, or should I hold out to see foreclosures and huge deals? So I think that opens up a subtopic on this episode to really dive into, because guys, I think we're not dealing with some apples to apples if you're looking at the Great Depression or the '08 crash, because comparing that to what it was a corrupt financial system as well as an underregulated lending process, we have completely tackled those. Like us three like it is very compliantly driven to issue residential loans now, and it's very, very hard and very conservative on the back end. Hopefully the consumer doesn't feel that. But guys, I want to bring it open. Like, what is your opinion on where the real estate market's going? I think we are in a great position. I generally speaking, I think it's a supply and demand. Right now, there are more people than housing on a national spectrum, and there's not enough houses for these people. And that's why we're still seeing these huge over asking prices. I mean, even on the weekends, it's over here in the Pacific Northwest, 6 to 12 freaking offers on a house, 20, 40, 50 grand over asking. So I like Christian, what do you think? Like, what's your opinion, nationally speaking, in the real estate market?
Yeah, well, I think you kind of answered a lot of your own questions, because we are seeing those over asking prices, escalation clauses. It's a very competitive market out there if you are a seller selling your property. As a purchaser, it's tough. We're hearing those stories of people just getting outbidded day in and day out. So yeah, I think we're financially in a much stronger situation than we were in '08. We're not doing these exotic loans that put us in this situation. Like you said, guidelines have tightened up. Yes, we still have the 3% down, but we put some real heavy guidelines on those. You got to have a more favorable credit score. We're going through the property. We're doing home buyers education. So all of those things that we've done to kind of correct or curb any of these things in our West Coast markets, I think, are very strong. Now, I do believe we'll talk about some of those second homes and investment properties maybe fall into some short sales in the desert states and whatnot. So I think those are going to be some different markets, but it will be a small portion that you'll see people that may be affected through this pandemic of COVID-19, and hopefully they can make it through. But there'll be some opportunities for investors out there for sure.
That's a super good point, because I also noted, like, at least here in the Pacific Northwest, I think if there's any deals that are going to be had, it's going to be at the coast, because to your point, those are the vacation properties. Those those are the things that offload first. And going back to our point, like, why are investment properties higher interest rates, right? Because those are the properties that get offloaded first. The primary ones get protected. And I think too, our governments and the feds will do whatever we possibly can to prevent a recession as much as possible. I mean, there's certain things like the unemployment rate skyrocketing, money can't even be funneled with cities being shut down. But I think you have to play into the fact that America is going to do what they can out of their ability for stim checks to make sure people have funding to pay their mortgages, pay their rent, fuel the economy. And I doubt too, with an upcoming election, I'm sure that is a really tough word for people to say publicly.
Yep.
Like, who's going to be president? You think Donald freaking Trump is going to let it slide into a real estate crash in the next like 4 to no, like whoever it is, even if it's him reelected or a new person, no one under their watch is going to, like, look at it this way. If you're running for class president, you're not going to let the teachers take away recess, right? You're going to make sure everyone gets lunch, snack, and recess. So I just don't see this huge dramatic swing that a lot of people are really concerned about, but then also home buyers thinking, should I hold off? Right? Casey, anything on your end, especially being a veteran and the different opportunities you guys have to take advantage of different programs?
Well, yeah. And I mean, the one thing I want to touch on that VA part of it too, because even me and Christian were talking about that before we came on the show, and we had a good little nugget there. But with our area too here, Portland, we got a lot of people moving here, so people have to understand that. I mean, we have a ton of, these tech center businesses, Intel, Nike and stuff. So we get here in the Northwest, we're becoming, a city that, we're getting used to as far as higher house prices, the influx of buyers, the competition and stuff like that. I mean, probably take us back, 10, 15 years ago, Portland, Oregon is it's obviously a way different Portland, Oregon, and wanted to be desired location for people to come live than it kind of used to be. So a lot of, California movers, people from California moving up here and stuff. So coming back to that investment side, or thinking that there's going to be, if there was a crash, let's just say, then if that's going to happen, I think you should start preparing now yourself financially, right? Because you're not going to be the only player out there in the game for these properties. I mean, if it's a crash, it's going to be for people that are going to want to invest or be investors, it's going to be game on. So if you're not, trying to save money now for that anticipation, if the market changes and you have opportunities there, then you're going to be stuck holding the bag again and saying, man, I wish I could have been an investor. But it's, so I think when opportunities like that happen, you need to kind of be pre-gaming for that months, years ahead, or trying to, because when the opportunity's there, you need to be able to strike it. Because if the opportunity's there and they're like, oh, we got to get some money and try to make this happen, it's going to be too much competition, I think. But coming back to the VA side, I think, this is a good point to make. VA home loan is made for your primary residence. It's not made to purchase an investment property. You're not going to use a VA home loan to purchase an investment property. It's just not happening. But Christian made a great point of this. You can obviously buy your first primary residence property with your VA loan, and then let's just say it is that 3-year mark, and you're looking to get another property. You can purchase that second property, that new primary residence for yourself as a conventional loan. You can leave that VA loan sitting on the old departing primary residence, and that can stay there as long as that loan isn't changed and that house is sitting there. I had a client that they were on their third property, and that VA loan was still on their original first primary residence, 3 properties behind them. And so that's another thing to consider too, is, for that VA loan, it can be a great opportunity for you to start your investment career, your real estate asset career with that first home. You buy it as a vet, you use your zero down, and you get that first property. Allows you to maybe save some money, or maybe you were saving money for the down payment, used your VA, didn't need it. Now you got an additional savings for that investment or that new primary later on, and you can then convert your previous one into an investment property. So it's a nice little trick with the VA loan that people think you have to constantly take that with you onto your next purchase. You don't have to. You can leave that tied to a property.
Yeah, I've seen that happen though. Like I've also seen people get into a VA like 7 or 8 years ago, and they stayed in it for 2, 3 years, whatever it was. Then they turned it into a rental and then refinance out of the VA into an investment property, which depending on where rates were at, it might be a rate improvement for some people. Mm-hmm. And then they freed up their eligibility once again to buy a new primary at a zero down obligation new VA loan. So yeah. There's a lot of different ways to kind of wiggle through. And that particular situation, since the refinance, all of the fees were actually financed in, it cost them zero money to purchase another home. So
and that's such a cool strategy.
Yeah, there's a few ways to do it, and I've seen it from top to bottom. Another like really quick question that I'm getting all the time, I really want the group's opinion on this, and I'll open with a shorter version of mine, is like where do we think interest rates are going? And I think what I would like to add in too for our home buyers and sellers, you're going to get a ton of freaking loan officers out there that try to use interest rates as an urgency sales tactic. I hear it all the time and it drives me nuts. Better move now, interest rates. Like, oh, come on. Like, by the way, you can't necessarily lock in your rate until you have an accepted offer. There are some lenders out there, I think like the Rocket was doing it for a bit. I don't know if they're back, but most of them aren't locking in terms until you have an accepted offer back. So like, first of all, like you can't even control where to be. They're changing every single day. However, like if you look at the span of where interest rates are, I mean, just a year and a half ago, we were in the mid to high fours. So for them to be for a high level credit, some sort of down payment, conventional loan, we're well under 4% now. In most situations, that's still unbelievable. Now, where I think they're going to be, all I can say is the United States, in my opinion, is 100% tied to the cost of money, not only for our businesses. How much does it take to get a small business loan, to get credit, but our auto, our mortgage lending, our business, our commercial, even the gosh darn government debt is tied to interest rates. So do you think that this economy, which definitely needs some sort of life raft, is going to skyrocket interest rates? I don't know. I'm pretty passionate about it. Kempers, what's your take on like the longevity of interest rates staying at a reasonable spot?
Well, like you said, there's a lot of the indicators to show that it's going to stay low. We have an election. I think that's a big part. I've been in the business for 18 years now, and through every election year, we don't see much movement in that 12 months going up to it. We're pretty stagnant, just for the same reasons. We don't want to see a lot of ups and downs going into that. Also, rates are, like you said, 4.5% was a good rate. Now we're at 3.5%, probably around par today. Help me out with my compliance here, depending on every situation.
Yeah, program. This isn't a commitment to lend. This isn't whatever NMLS. So these are general national averages. Google it.
Bankrate. We got it from Bankrate.
If you Google interest rates today, Google shows national averages. Just a little thing right there. So go look at that.
Yeah, definitely. So I feel like they're still going to be low. We're going to have to take advantage of those, peaks and valleys. The stock market's going to rally like it did today. We had just a huge day in the market. I think it was plus 800. So we're going to see the MSB go down a little bit. We're going to suffer for a few days. Now, for my refinance people out there, you have the luxury of kind of really playing the game, right. Work with me to find those right dates to lock. And so we're taking a different stance. We're getting you through the underwriting process. We're getting it all cleaned and ready to go so that we can take advantage of a 15-day lock and really provide you with the best advantages to get the lowest rate possible, and be strategic about it. Now, everybody's scenario is different. Some people are going to be, that's going to be the forever home. So sometimes we're looking at buying that rate down to the lowest we can. I got someone that's looking at a 2.875 today, but they're going to pay for that because they know that this is their forever home. They want to refinance this last time. So I'm a firm believer in the annual or semi-annual meeting with your loan officer so that we can be strategic for that next purchase, for that next investment property. We need to be talking about these things 6 to 12 months prior, knowing that you're going to go into a new primary, knowing that you want to invest into that second home or investment property. It is so important that we set you up to succeed, but I need to know all the facts, all the different things that are coming up into play so that as I see things coming in and regulations changing, that I can prepare you for that so that we're not blindsided in 6 months or a year down the road because things have changed. So please, 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 just like with your insurance agent, your doctor, anybody else, you should be having these same checkups with your mortgage advisor. We are advisors that help you get to your next level in life. I think that's huge.
Yeah, that's huge. I want to touch just one part of that, Addy.
What you got, Casey?
Got the election years and interest rates up there. People forget too with the election year, if you have a change of a president, you also have a change of an agenda. Each president has their own agenda, right? We saw, Donald Trump get elected, 16. That was November, right? The elections started happening, right? And he gets elected. And then what happens? We saw in March, agenda change, interest rate, hike. The Feds started doing their first interest rate increasement. So we saw that first hike in March, 0.25% interest rate hike, and then you saw it in June, and then you saw it in September. So what I'm getting to is another thing to be aware of is when you have these election years, you have maybe a presidential change, you will have an agenda change. And what's that going to be? Are they going to be focused on, more of the economy driven stuff? Are they going to be focused more on the health side of stuff? So that stuff is something to still be aware of because it will, one way or another affect the real estate market.
Yeah, I think that's a good point. Like everyone's got a different agenda. I just still don't think with 2020 being a pandemic year, I don't think anyone's going to try to rock the boat. I really don't. I think we're going to stay in that relatively lower rate for a lot of the other reasons I panned off. And I just got another quick question via iMessage. Your second homes, what does it take? I think that's a really good subject. We can kind of maybe land the plane on that because that's another consideration not a lot of people know. So if you are buying a second home, you actually have some lower down options, as low as 10% on a conventional loan for your second property. Now you'll want to get with your specific lender you're working with to see what their lender requirements is. But I believe it's like it changes every year, right? Kemper's like 85-mile distance from your primary to your new, something like that. Casey?
Unless it's like a destination area. So I think we're closer than that to the beach, or if it was near a recreational area.
Oh, like special exception.
Yeah, if it makes sense, let's say if it makes sense, it makes sense. Now, I may have a daughter that's going to school in Seattle, and I'm going to get a second home there so I can be visitor near there. Yeah, that would work as well. It's all just going to make sense. It's all about how we write it up, and you're telling me what you're doing with the property. I'm going to tell you, yeah, that's investment or not. Now, are you going to be getting any rental income from it? Then that would be an investment property. Now, if you're just going to be yourself, your daughter in the home, then that's a second home. So we talk about all those things as we're preparing the file for that property.
Yeah, and an underwriter is going to have you attest to the fact that you're using it for a vacation home. So within your file going through underwriting, you are going to sign and explain that, hey, this is the reasoning for my vacation home. Like we literally, like to your point, like we go to X city to visit family all the time. This makes sense for us financially, blah, 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 blah.
I had a good one. It was pretty close in radius. I don't remember exactly what it was, but it made sense because it was a condo on the mountain and they like to ski, but they lived, let's just say, if it was, Portland or whatever, wherever that primary was, it wasn't completely crazy amount of distance, but it made sense because they went to the mountain every weekend. They're going to stay in their condo. They're going to ski it up. And it made sense for a second home per the underwriter and everything. So yeah, you want to explain that story.
Mm-hmm.
But you got to remember, underwriters see so many files; they can see everything. That's the number one fraud item in the mortgage industry is occupancy,
Occupancy.
and it's not even smart to even try to get around it.
It's not worth it.
It's not worth it. I'm going to end up doing a refinance for you down the road. I'm going to see it on your Schedule E, and I'm going to be talking to you about it right away. If I see that, that same next year we're pulling out cash for another property, it's like, come on, let's get the story straight. What are we doing here? So I'm also going to make sure that you're not going to get in trouble either and walk you down that straight, narrow line and say, hey, we've seen this before. And, we talk about all those people in 08 and 09 that that's what they nailed people on, and these little things, just because it was easy. They signed a rider saying that it was going to be a second home or a primary residence, and then if they turn that in, that's fraud, 100%. And so talk to your mortgage advisor to make sure that they're putting you in a win-win situation.
Yeah, that's a good point. And kind of just to bookend that comment, like I get some people be like, oh, well, why is it so hard? Like people who maybe haven't done a mortgage in 20 years and now they're doing it's like, this is totally different than what I experienced 2 decades ago. I was like, yeah, a lot's happened since freaking 2000, Yeah. So you're explaining like these regulation and investor guidelines to conventional financing. The structuring of the guidelines to get approved is designed not to put someone into a position where they're going to foreclose. So as much as it is challenging, I think another note is it's not up to the loan officer. Like I've had people push back and be like, why would you ask for that? Like it's me. And it's like, dude, I don't pick and choose. I'm literally reading the guideline. Here's a copy. This is what I'm trying to prep your file for the path of least resistance to be presented to the underwriter. We want it to go just as much as you. We don't make things up to make it harder. And I think that's one kind of misperception that some people think that like, Casey's being a jerk and just over asking and making up rules. It's not like we sit around the Thanksgiving table and come up with a way to make it harder to do all of our jobs. Like, yeah, pass the potato. Let's make this harder for Jimmy. No, we're not trying to do that.
Right. Our job is to show the ability to repay the loan, and your job as the client is to provide the documents to support the application that you gave us. The underwriter doesn't know anything unless you've given it to us. So it's the documents matches the application. That's what we're looking for. So again, back to your mortgage advisor. It's about being prepared and getting set up correctly. And back to the investment properties, like we talked about, it starts with that one. If that's your goals, gosh, man, that's a great 10-year plan for me to get you, your next 4 properties, and we will get you there. I've done it for many other clients, and the roadmap's been already written out there. It's just if you want to plug and play.
Yeah. Yep, that's a really good point. And I think we're going to slide into home on that note. So, hey, thank you for everyone that has supported MLO thus far, the reach outs, especially from the podcast side of it all. Grab us, pick us up wherever you get your podcast. We're in there. MLO, Modern Loan Officer. We truly enjoy meeting every single week, Wednesdays and Fridays consistently. And reach out, holler, text, call, send us an email, send us a comment. We're here to help. Like we've gotten reach outs from Atlanta this week. We reach outs from Texas. And we're here with the one common goal of creating an atmosphere of transparency specific to home buying and selling. So we're here to give the truth, and here is a resource. So, gentlemen, thank you again for being on, Casey and Christian. And until next time, should we slide in to sardines to close it out? Love it. Bring it up. Down. Casey has the best dance moves for the sardine switch. We got sardine hot dog. Bring it. Sardine dog. Show me what you got, Casey. Boom. You're in the middle. You're always in the middle.
I'm like a sleeping bag.
Yeah. Casey's always warm in the tent. All right, guys. Have a good evening. Have a good weekend. This is Daddy Net MLO. Talk to you later.
Peace.